Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, mortgage broker, or real estate agent. This presentation is for educational and informational purposes only and should not be considered financial, legal, or tax advice. The world of real estate and finance changes rapidly, so please consult with a qualified professional for advice tailored to your individual situation before making any financial decisions. Let me tell you a quick story about two neighbors. Let's call them the Millers and the Davidsons. They bought identical houses right next door to each other in the same month for the exact same price, $500,000. Fast forward 7 years. The Millers have built over $100,000 in equity, refinanced to a lower rate, and are on track to own their home free and clear 8 years early. The Davidsons? They've paid almost the same amount of money, but they're barely keeping up with interest. They've paid tens of thousands in extra insurance and they feel trapped. What was the difference? It wasn't their income. It wasn't their savings. It was the single most important and most misunderstood financial decision of their lives: the type of mortgage they chose. The piece of paper they signed on closing day set them on two completely different financial destinies. And that is the terrifying truth. Choosing the wrong mortgage can cost you more than a bad stock pick, more than a failed business venture. It can cost you hundreds of thousands of dollars over the life of your loan and dictate your financial freedom for the next 30 years. You're here because you know this. You've probably felt that knot in your stomach. You see the terms FHA, VA, USDA, conventional 30-year fixed, 15-year fixed, 5-to-1 ARM, jumbo, conforming, and your brain just turns to static. It's an alphabet soup of financial jargon designed, it seems, to confuse and overwhelm you. Banks and lenders love this confusion, because a confused buyer is a compliant buyer. A confused buyer doesn't ask the right questions. A confused buyer signs on the dotted line and hopes for the best. Well, that ends today. Right now. The purpose of this guide is to completely shatter that confusion. We are going to arm you with the knowledge to walk into a lender's office not as a hopeful applicant, but as a confident, educated expert on your own financial future. By the time this is over, you will understand exactly what these loan types are, who they are for, and most importantly, which one is the perfect financial weapon for you to build wealth and secure the home of your dreams. This isn't just about avoiding a mistake. It's about actively using your mortgage as a tool to get ahead financially, just like the Millers did. So let's get into it. The first and most fundamental fork in the road you will encounter is the choice between a conventional loan and a government-backed loan. Every other loan type we discuss will essentially fall into one of these two massive categories. Getting this one right is half the battle. Let's start with the big one: conventional loans. The name sounds boring, conventional, like it's the default plain vanilla option, and in many ways it is. But simple doesn't mean weak. A conventional loan is any mortgage that is not insured or guaranteed by the federal government. It's a straight-up deal between you and a private lender. A bank, a credit union, a mortgage company. They are the ones taking on the risk if you fail to pay. Because they're taking the risk, they get to set most of the rules. This is why conventional loans are typically best for borrowers who look good on paper: a strong credit score, a stable income, and a decent down payment. Think of it as the A student's mortgage. If you've done your financial homework, this is often your reward. Now, within the world of conventional loans, there's another crucial split you need to know: conforming versus non-conforming. This sounds technical, but it's incredibly simple. A conforming loan is a loan that conforms to a set of rules and dollar limits set by two giant government-sponsored enterprises called Fannie Mae and Freddie Mac. You don't need to know the inner workings of these companies, you just need to know this. They set a maximum loan amount which is updated every year. For 2026, let's say that limit is around $770,000 for a single-family home in most of the country. If your loan is at or below this amount, it's a conforming loan. Lenders love these because they can easily sell them to Fannie and Freddie, which frees up their money to lend to someone else. It's the standard mass-produced mortgage. But what if you're buying a more expensive home? What if you need to borrow, say, $1 million? Well, then you enter the world of non-conforming loans, which are most commonly known as jumbo loans. A jumbo loan is simply a conventional loan that is above the conforming limit. Because the lender can't sell this loan to Fannie or Freddie, they have to keep it on their own books. This means they are taking on a much bigger risk for a much longer time. And what happens when a lender takes on more risk? They get stricter. Jumbo loans almost always require a higher credit score, a larger down payment, often 20% or more, and proof that you have significant cash reserves left over after you close. So why would anyone choose a conventional loan? The advantages are huge if you qualify. First, flexibility. You can use them to buy a primary residence, a second home, or an investment property, which isn't always the case with government loans. Second, the process can be faster. There's often less red tape and fewer property restrictions. A government appraiser isn't going to tell you that you need to fix a chipped handrail before the loan can be approved. But the biggest advantage, the holy grail for conventional borrowers, is the potential to avoid a dreaded expense called PMI. You need to burn these 4 letters into your brain. It stands for private mortgage insurance. And despite the name, it does not protect you. It protects the lender. If you get a conventional loan and put down less than 20% of the home's purchase price, the lender sees you as a higher risk. To offset that risk, they force you to pay for an insurance policy (PMI) that pays them if you default on your loan. It's an extra fee, rolled right into your monthly mortgage payment, that can cost you anywhere from a few dozen to several $100s every single month. It does absolutely nothing for you except drain your bank account. It is quite literally money you are setting on fire. The beauty of a conventional loan is that PMI is not permanent. The moment your loan balance drops to 80% of the home's original value, you can call your lender and request to have the PMI removed. And by law, they are required to automatically terminate it once your balance hits 78%. This is a massive advantage. You pay the PMI for a few years, build up that 20% equity through your payments and home appreciation, and then poof, it's gone and your monthly payment drops significantly. So let's recap conventional loans. They are the workhorse of the mortgage industry. They're great for borrowers with solid credit, think 680 or higher, ideally above 740, and for those who can put down a substantial down payment, especially that magic 20% to avoid PMI from the start. They offer flexibility for different types of properties and can have a smoother closing process. But what if you don't have a 740 credit score? What if saving up a 20% down payment, which is over $100,000 on a $500,000 home, feels absolutely impossible? Do you just give up on the dream of homeownership? Absolutely not. Because this is where the other side of the mortgage universe comes into play. This is where the federal government steps in with a series of powerful game-changing programs designed specifically to help people who don't fit into that perfect conventional box. We're talking about loans that allow you to buy a home with as little as 3.5% down, or in some cases with 0. That's right, absolutely nothing out of pocket for the down payment. These are the loans that have opened the door to homeownership for millions of Americans, and understanding how they work is the next critical piece of the puzzle. Let's start with the loan that is, without a doubt, one of the most incredible benefits offered in this country. The VA loan. This isn't just a home loan. It's a promise fulfilled. It's a thank you, earned through sacrifice and service, available exclusively to eligible active duty service members, veterans, and in some cases, surviving spouses. The headline feature, the one that changes everything, is that $0 down payment. Think about that for a second. For a $400,000 home, where a traditional loan might require an $80,000 down payment, a VA loan allows you to move in without putting a single dollar down on the principal. This single benefit has catapulted more service members into homeownership than almost any other program. But the power of the VA loan doesn't stop there. Here's the second, equally massive advantage. No private mortgage insurance or PMI. On almost every other type of loan, if you don't put down at least 20%, the lender sees you as a higher risk. To protect themselves, they force you to pay an extra monthly fee, the PMI, which can easily add hundreds of dollars to your payment. That money doesn't go towards your principal, it doesn't build your equity, it's just a fee. With a VA loan, that fee simply does not exist. It's waived. So, you get 0 down payment and no monthly mortgage insurance. This combination can make your monthly payment significantly lower than other loans, even if the house price is the same. So what's the catch? There's always a catch, right? Well, not exactly a catch, but there is a cost, and it's called the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs to help keep the program running for future generations without costing the taxpayer. This fee can be paid up front at closing, or as most people do, rolled into the total loan amount. The percentage varies depending on your service, whether it's your first time using the benefit, and how much you're putting down, if anything. For a first-time user with 0 down, it's typically just over 2% of the loan amount. However, and this is a critical piece of information, many veterans are completely exempt from this fee. Specifically, veterans receiving VA disability compensation and surviving spouses of veterans who died in service or from a service-connected disability do not have to pay the funding fee at all, making the loan even more powerful. Now let's journey from the barracks to the countryside and talk about the best-kept secret in American real estate: the USDA loan. When people hear USDA, they think of farms, cows, and endless fields of corn. And while this loan is designed to promote homeownership in less dense areas, the definition of rural is way bigger than you think. We're not just talking about remote farmland. We're talking about thousands of small towns and suburbs all across America. In fact, about 97% of the geographical United States is in a USDA-eligible area. You can literally go on the USDA's website, type in an address, and see if it qualifies. You would be shocked at how many beautiful, desirable suburban neighborhoods are eligible. Just like the VA loan, the USDA Loan Superstar feature is a 0% down payment. Again, nothing out of pocket required for the down payment. This program is specifically designed for low to moderate income borrowers who want to own a home in a qualifying area. So there are two major hurdles you have to clear. First, the property has to be in an eligible zone. Second, your household income cannot exceed a certain limit, which varies by region and family size. The goal is to help people who might not have the savings for a big down payment, not to finance mansions for the wealthy. Unlike the VA loan, the USDA loan does have a form of mortgage insurance. It has two parts: an upfront guarantee fee of 1% of the loan amount, which is almost always rolled into the mortgage, and an annual fee of 0.35%, which is broken up and added to your monthly payments. Now, while that sounds like a downside, the key is that the USDA's annual fee is significantly lower than the mortgage insurance on many other loan types. So even with this fee, a USDA loan can often result in a lower monthly payment than our next loan, the FHA loan. The USDA loan is a phenomenal, underutilized tool for anyone who isn't a veteran but still dreams of a zero-down mortgage and doesn't mind living just outside the hustle and bustle of a major city. But what if you're not a veteran, and you want to live in a place that doesn't qualify for a USDA loan? What if you're like millions of other Americans? You have a steady job, but your credit score isn't perfect, and saving up 20% for a down payment feels like trying to climb Mount Everest in flip-flops. For you, the FHA loan might be the answer. The FHA loan, which is insured by the Federal Housing Administration, is the workhorse for first-time homebuyers in America. Let's be clear right up front. This is not a zero-down loan, but it is the next best thing. The FHA program allows you to buy a home with as little as 3.5% down. On that same $400,000 house, that's a $14,000 down payment. That is still a lot of money, but it is a world away from the $80,000 a 20% down payment would require. This dramatically lowers the barrier to entry, but the low down payment is only half the story. The FHA's real superpower is its flexibility with credit scores. Where other loans might automatically deny you for having a credit score in the low 600s or even high 500s, the FHA program is designed to give you a chance. The government is essentially co-signing for you, telling the lender, hey, we'll back this loan, so you can take a chance on this borrower. This flexibility has made homeownership a reality for people who were told it was impossible. Of course, this flexibility comes at a cost. And it's a big one. It's the FHA's version of mortgage insurance, called the Mortgage Insurance Premium, or MIP. And it is the FHA loan's greatest weakness. Just like the USDA loan, it has two parts. First, there's an upfront mortgage insurance premium, which is 1.75% of your loan amount. And just like with other loans, this is usually rolled into your mortgage so you don't pay it out of pocket. But then there's the second part, the annual MIP, which is added to your monthly payment. And here is the critical, must-know, non-negotiable fact about FHA loans. If you put down less than 10%, you will pay that monthly mortgage insurance for the entire life of the loan. It never goes away unless you refinance into a different type of loan. This is a massive long-term cost, and it's the trade-off you make for that low down payment and flexible credit requirement. So you have these three pillars of government-backed lending. The VA loan, an incredible zero-down benefit for our military heroes. The USDA loan, a zero-down secret weapon for those seeking life in smaller towns and suburbs. And the FHA loan, the low down payment gateway for the determined buyer who needs a little more flexibility. These programs have fundamentally changed the landscape of homeownership in America, but they aren't for everyone. What if you don't fit into any of these boxes? What if your credit is excellent, you've diligently saved up a 5, 10, or 20% down payment, and you want to buy a condo in the heart of the city? For you, a completely different universe of lending opens up. One that could potentially save you tens of thousands of dollars in the long run. I'm talking about the loans that over 60% of all homebuyers use. The workhorses of the industry, conventional loans. And understanding how they operate, and when they are a much smarter choice than these government programs, is the next crucial step in your journey. So let's pull back the curtain on these financial power tools. Conventional loans are, in the simplest terms, mortgages that are not insured or guaranteed by the federal government. Unlike FHA, VA, or USDA loans, if you stop making payments on a conventional loan, the lender is the one on the hook. There's no government agency stepping in to cover their losses. And because the lender is taking on all that risk themselves, they are going to be a lot pickier about who they lend money to. Think of it like this: government-backed loans are like the training wheels on a bicycle. They make it easier for people with a few wobbles, maybe a lower credit score or not much for a down payment, to get started on the path to homeownership. Conventional loans are the two-wheeler. They offer a faster, more efficient ride with more freedom, but you need to prove you have the balance and strength to handle it. So what does that strength look like to a lender? It boils down to a few key metrics. First, your credit score. While government programs can sometimes dip into the high 500s, for a conventional loan, the absolute floor is generally a 620 credit score. But let's be brutally honest here. 620 is just the price of admission. It gets you in the door, but you're not getting the VIP treatment. The real magic, the best interest rates, the lowest costs, that starts to happen when your credit score climbs into the 700s, with 740 and above being the gold standard. A higher score tells the lender you are a statistically lower risk, and they reward that reliability with a lower interest rate, which can save you tens of thousands of dollars over the life of your loan. Next is your debt-to-income ratio, or DTI. We talked about this before, but it's even more critical here. Conventional loan guidelines are typically stricter. Lenders generally want to see your total monthly debt payments, including your new potential mortgage, stay below 43% of your gross monthly income. Some programs might stretch to 45 or even 50% if you have other compensating factors like a huge down payment or significant cash reserves, but 43% is the number to aim for. And this brings us to the single biggest myth in the entire mortgage world. The one that has stopped millions of people from even trying to buy a home. It's the idea that you absolutely must have a 20% down payment for a conventional loan. Let me say this as clearly as possible. That is completely, unequivocally false. For decades, this 20% figure has been hammered into our heads as a non-negotiable rule. But the reality of the modern mortgage market is very different. You can absolutely get a conventional loan with far less. In fact, major players like Fannie Mae and Freddie Mac, the giant government-sponsored enterprises that buy most of the conventional loans in the US, have programs that allow for as little as 3% down. That's right, 3%. That's even lower than the FHA's 3.5% minimum. There are also countless 5% and 10% down payment options available. So if you can get a loan with only 3% down, why does everyone talk about 20%? Comes down to one thing: risk. From the lender's perspective, a borrower who puts down less than 20% is riskier. They have less skin in the game. If home prices were to fall, a borrower with a tiny down payment could owe more than the house is worth very quickly, making them more likely to walk away. To protect themselves from this risk, lenders require you to pay for something called private mortgage insurance, or PMI. And this is where we need to pause and focus, because understanding PMI is the key to mastering conventional loans. PMI is an insurance policy that you, the borrower, pay for. But it doesn't protect you. It protects the lender. If you default on your loan, the PMI company steps in and pays the lender to help cover their losses. It is the price you pay for the privilege of putting down less than 20%. How much does it cost? It varies based on your credit score, your down payment amount, and the loan size, but a typical range is between 0.5% and 1.5% of the loan amount per year, broken up into monthly payments. So on a $400,000 loan, you could be paying an extra $150 to $250 per month, on top of your principal, interest, taxes, and homeowner's insurance. It's a significant extra cost. But here is the beautiful, powerful, game-changing difference between conventional PMI and the mortgage insurance on an FHA loan. On an FHA loan, if you put down less than 10%, that mortgage insurance premium is stuck with you for the entire life of the loan. The only way to get rid of it is to refinance or sell the house. But on a conventional loan, PMI is temporary. It's designed to go away. You have a secret weapon: your home equity. Equity is the portion of your home that you actually own. As you make your monthly mortgage payments, your loan balance goes down. And as the years go by, your home's value will hopefully go up. The combination of these two factors builds your equity. Once your loan balance drops to 80% of your home's original purchase price, you can formally request that your lender cancel your PMI. They'll likely require an appraisal to confirm the home's value. But once you hit that 20% equity mark, you can petition to have that PMI payment removed forever. Even better, federal law, the Homeowners Protection Act, requires lenders to automatically terminate your PMI once your loan balance is scheduled to reach 78% of the original value. So, even if you do nothing, it will eventually disappear. This is a massive advantage over FHA loans and a primary reason why, if you can qualify, a conventional loan is often the smarter long-term financial choice, even if you have to pay PMI for a few years. Now, within the world of conventional loans, there's one more major division you need to know about: conforming versus non-conforming loans. Sounds technical, but the concept is simple. Remember Fannie Mae and Freddie Mac, the two giants that buy up mortgages? Well, they have rules. And one of their biggest rules is a limit on how large a loan can be. This is known as the conforming loan limit. This limit is set every year by the Federal Housing Finance Agency, and it varies by county. In most of the U.S. in 2026, this limit will likely be somewhere north of $800,000 for a single-family home. However, in designated high-cost areas, think San Francisco, New York City, parts of Southern California, that limit can be significantly higher, potentially over $1.2 million. A conforming loan is simply a mortgage that falls at or below this limit. Because these loans can be easily sold to Fannie and Freddie, they are very common, have competitive interest rates, and follow standard guidelines. But what if you need to borrow more than that? What if the home you want costs $1.5 million in an area where the limit is $1 million? Then you need a non-conforming loan, more commonly known as a jumbo loan. A jumbo loan is exactly what it sounds like: a giant loan for an expensive property. Because it exceeds the conforming limit, it can't be sold to Fannie or Freddie. This means the individual lender who gives you the loan has to keep it on their own books, which exposes them to a lot more risk. And just like before, when risk goes up, requirements get stricter. For a jumbo loan, you'll typically need an even higher credit score, often 700 or 720 minimum. You'll need a larger down payment, with 10 or 20% being common requirements. And they will scrutinize your income, your assets, and your job stability with a fine-tooth comb. You'll need to prove you have significant cash reserves left over even after your down payment and closing costs. Jumbo loans are the major leagues, reserved for well-qualified borrowers buying high-end real estate. So, you have the workhorse conventional loan with its flexible down payments and its temporary beatable PMI. And you have its bigger, more demanding sibling, the jumbo loan, for when your home buying dreams exceed the standard limits. These two tools offer incredible flexibility and, for the right borrower, are often the most cost-effective way to finance a home. The question now becomes, how do you decide? When does a 3% down conventional loan with PMI make more sense than a 3.5% down FHA loan with its lifetime mortgage insurance? The answer involves a head-to-head showdown, and when you run the numbers, the results are often not what you'd expect. Let's run the numbers on a hypothetical $400,000 home. Our first home buyer, let's call her Sarah, has a good credit score, say a 740. She's trying to decide between FHA and a low down payment conventional loan. With an FHA loan, her minimum down payment is 3.5%, which is $14,000. This leaves her with a base loan amount of $386,000. But wait, remember that FHA upfront mortgage insurance premium? At 1.75%, that's another $6,755 that gets tacked on. So her total loan amount isn't $386, it's actually $392,755. It's rolled right in. Then, she has her monthly mortgage insurance premium. At the current rate of 0.55% per year, that adds about $180 to her monthly payment. And that $180 a month is there for the entire life of the loan, unless she refinances. Now let's look at the conventional option. Sarah can get a conventional loan with just 3% down. On that same $400,000 house, that's only $12,000. Right off the bat, she's bringing $2,000 less to the closing table. Her loan amount is $388,000. Since she has a great credit score, her private mortgage insurance or PMI is going to be relatively cheap. Let's say it's 0.5%. That comes out to about $162 a month. So side by side, the monthly mortgage insurance is a little cheaper on the conventional loan. But here is the multi-thousand-dollar difference. That $162 PMI payment is temporary. Once Sarah pays her loan down to about 78% of the home's original value, that PMI payment automatically terminates. It vanishes. Poof, gone forever. The FHA payment of $180, however, keeps going and going and going. Over 30 years, that lifetime FHA insurance could cost Sarah over $60,000. The conventional PMI? Maybe $12,000 to $15,000 before it disappears. In this scenario, for a borrower with good credit, the conventional loan is the clear winner. Less cash up front, and a mortgage insurance payment that has an expiration date. But what if our homebuyer, let's call him Mike, has a more challenging credit history? Say his score is a 640. This is where the entire equation flips upside down. For FHA, the rules are pretty much the same. The insurance rates don't really change based on credit. Mike's monthly FHA mortgage insurance is still going to be around that $180 mark. But for a conventional loan, a 640 credit score is a game changer. Lenders see more risk, so they charge much higher PMI rates. Instead of 0.5%, Mike's PMI rate might be 1.2% or even higher. Suddenly, his monthly PMI payment on that same loan isn't $162. It's $388 a month. That's a massive difference. In this case, the FHA loan, even with its lifetime insurance, is over $200 cheaper per month right from the start. For Mike, FHA is the obvious choice. It allows him to get into the house with a manageable payment. The strategy for him would be to take the FHA loan now, work on improving his credit, and then once he has enough equity, refinance into a conventional loan later to ditch the mortgage insurance. So the FHA versus conventional showdown doesn't have one simple winner. The winner is determined by your specific financial snapshot, especially your credit score. FHA is your ally for lower credit scores, while conventional rewards you for having a high score. Now, while FHA and conventional loans are the most common, they are not the most powerful. There is another loan, a government-backed mortgage that, for those who qualify, is the undisputed heavyweight champion of the world. It's a loan so good it almost sounds like a myth. I'm talking about the VA loan. The VA loan is a mortgage option available to veterans, active duty service members, and eligible surviving spouses. It's not a loan from the government, but rather a loan from a private lender that is guaranteed by the U.S. Department of Veterans Affairs. This government guarantee gives lenders the confidence to offer incredible terms. And the number one headline-grabbing, most unbelievable feature of the VA loan is this 0% down payment. Not 3%, not 3.5%, 0. A qualified veteran can buy a home with absolutely no down payment, up to the conforming loan limits in their area, and often even higher for those with full entitlement. This single benefit can shatter the biggest barrier to homeownership for millions, saving up a massive pile of cash for the down payment. But it gets even better. We just spent all this time talking about the expensive headache of mortgage insurance, PMI on conventional loans and MIP on FHA loans. The VA loan's second superpower? There is no monthly mortgage insurance. Ever. Think about that. You can put $0 down on a home, a situation that would normally require the most expensive mortgage insurance, and you pay absolutely $0 in monthly mortgage insurance. This is a benefit that can save homeowners hundreds of dollars every single month compared to any other loan type. So what's the catch? There has to be a catch, right? Well, there is, but it's a small one: the VA funding fee. This is a one-time fee paid to the VA to help keep the program running without costing taxpayers. The fee is a percentage of the loan amount, and it varies depending on a few factors: your branch of service, whether it's your first time using the benefit, and the size of your down payment, if you choose to make one. For a first-time user with zero down payment, the funding fee is typically 2.15% of the loan amount. For a subsequent use, it's usually 3.3%. However, if you do decide to put some money down, say 5%, that fee drops significantly. And just like with an FHA loan, this fee can be rolled into the total loan amount so you don't have to pay it out of pocket. Let's be clear. Even with this funding fee rolled in, the VA loan is almost always the better deal. A slightly higher loan amount is nothing compared to the crushing weight of monthly mortgage insurance for years on end. The monthly payment on a VA loan will be significantly lower than a comparable FHA or conventional loan with a low down payment. And there's one more incredible exception. Veterans who receive VA disability compensation are typically exempt from the VA funding fee entirely. For these veterans, it is a true zero down, zero mortgage insurance, zero funding fee loan. It is, without question, the best mortgage deal on the planet. So if it's so great, are there any downsides? There are a few considerations. First, and most obviously, you have to have the required military service to be eligible. Second, the home you're buying must meet the VA's minimum property requirements, or MPRs. The VA wants to ensure that veterans are buying homes that are safe, sound, and sanitary. This means a VA appraiser might be a bit stricter than a conventional appraiser, sometimes calling out things like peeling paint, a leaky faucet, or a missing handrail that must be fixed before the loan can close. This can be a hurdle, especially with older homes that need a little work. Finally, there's a persistent myth in the real estate world that VA loans are slow and difficult to close. This can sometimes make sellers in a hot market nervous about accepting an offer from a VA buyer. This is largely outdated. With a good, experienced lender, a VA loan can close just as quickly and smoothly as any other type of loan. For the millions of Americans who have served our country, the VA loan isn't just a mortgage. It's one of the most valuable benefits earned through service. It makes homeownership dramatically more accessible and affordable. But what if you didn't serve in the military, and your credit isn't perfect, and you don't live in a major city? Is there a loan for you? You bet there is. There's another government-backed loan that is one of the best-kept secrets in the mortgage industry, designed specifically for Americans in suburban and rural areas. It's a loan that, like the VA loan, also offers the magic of a true zero down payment option, and it's called the USDA Rural Development Loan. Now, when you hear USDA, you probably think of the grade on a package of steak at the grocery store, the United States Department of Agriculture. And you might be thinking, what does the government agency in charge of farming and food have to do with my mortgage? That's the exact question that keeps this loan a secret. People hear agriculture, and they immediately assume you need to own a 1,000-acre farm, wear overalls to the closing, and have a pet cow. But what if I told you that the same department that ensures your food is safe could also be your golden ticket into a home with absolutely, positively zero money down? Let's meet a young couple. We'll call them Mark and Jessica. They live about 45 minutes outside a major city. They've been diligently saving, but in today's market, scraping together a 3%, let alone a 20% down payment, feels like trying to fill a swimming pool with a teaspoon. They see their friends in the city using FHA loans, but they want a little more space, a yard for a future dog, and a quieter neighborhood. They feel stuck, priced out of the city and believing they're on their own in the suburbs. They assume no down payment means no house. They have no idea that their dream of a home in that quiet suburb is not only possible, it's encouraged by one of the most powerful loan programs in the country. The USDA loan is not for farmers. Let me say that again. You do not have to be a farmer. This is the single biggest myth, and it's what stops millions of Americans from even looking into it. This loan was created to encourage growth and development in less populated areas, and the government's definition of rural is incredibly generous. We're not just talking about towns with one stoplight. We're talking about huge swaths of suburban America. In fact, 97% of the landmass in the United States is in a USDA-eligible area. There are eligible suburbs right outside of Los Angeles, Chicago, Dallas, and Orlando. Chances are the charming town you've been eyeing just outside the city limits is eligible. So how does it work? Just like the VA loan, the USDA doesn't typically lend you the money directly. Instead, they guarantee the loan for a private lender, your local bank or credit union. This guarantee is like a promise from the US government to the bank, saying, hey, if Mark and Jessica ever default on this loan, we'll cover your losses. This removes almost all the risk for the lender. And with no risk, the lender is happy to offer unbelievable terms, the most incredible of which is the 100% financing. $0 down. Now, your mind is probably racing with the buts. There has to be a catch, right? Let's tackle them head-on. The first catch is the location. The property must be in a designated eligible area. But checking this is unbelievably easy. The USDA has an eligibility map right on their website. You can type in any address in the country, and in 2 seconds it will tell you if it qualifies. It's a simple yes or no. For Mark and Jessica, this was the light bulb moment. They typed in the address of a neighborhood they loved, a place they just assumed was too normal to qualify for some special government program. And then the word popped up on the screen. Eligible. Their entire world of possibility just cracked wide open. The second catch people assume is income. They think you have to have a very low income to qualify. And while there are income limits, they are often much higher than you'd expect. The limit is typically set at 115% of the median household income for that specific area. In many suburban counties across America, this means a family of 4 can earn over $100,000, sometimes significantly more, and still be eligible for a USDA loan. The government doesn't want to limit this program to only the lowest earners. They want to incentivize working-class and middle-class families to build lives and communities outside of the major metropolitan cores. The final catch people worry about is the property itself. They imagine the USDA will only approve dilapidated farmhouses. This is completely false. The home simply has to meet basic health and safety standards, just like with an FHA or VA loan. It can be a brand new build in a new subdivision, a 20-year-old home in an established neighborhood, or a condominium. As long as it's a modest home that will be your primary residence, and it's safe and sound, it's likely on the table. So what's the real catch? There are two, but they're manageable. First, unlike the VA loan, the USDA loan does have a form of mortgage insurance. It's not called PMI, it's called a guarantee fee. It has two parts: an upfront fee that gets rolled into your total loan amount so you don't pay it out of pocket, and a smaller annual fee that's paid monthly in your mortgage payment. The good news? The USDA guarantee fee is almost always lower than the mortgage insurance premium on an FHA loan, saving you money every single month. The second thing to know is that this is not a program for investors. This loan is exclusively for people who will live in the home as their primary residence. You can't use it to buy a vacation home or a rental property. But wait, there's one more layer to this. A secret within the secret. There are actually two types of USDA loans. The one we've been talking about is the USDA guaranteed loan, where a private bank makes the loan and the government guarantees it. This is what 99% of people will use. But for very low-income families, there is the direct loan. In this case, the USDA is the lender. You work directly with the government to get your mortgage. And the terms are simply astonishing. The interest rates can be subsidized down to as low as 1%. That's not a typo. 1%. This program is a true lifeline, designed to make homeownership possible for families in rural areas who have no other path. The income thresholds are much lower, and the process is more involved, but for those who qualify, it can be a life-altering opportunity. So for Mark and Jessica, the journey transformed overnight. They went from feeling hopeless about a down payment to realizing they could get 100% financing for a home in a town they already loved. Their income was well within the limits, and the monthly guarantee fee was a small price to pay for getting into a home years before they thought possible, building equity, and finally getting that yard for their dog. The FHA, the VA, and the USDA loan are the three titans of government-backed mortgages. They have opened the doors to homeownership for millions of Americans who would have otherwise been locked out. First-time buyers, veterans, and families building lives outside our biggest cities. They prove that you don't always need a massive 20% down payment to buy a home. But what if you do have a good down payment? What if your credit score is excellent, and you don't fit into the specific boxes of an FHA, VA, or USDA loan? Then you're ready to enter the world of conventional loans. This is the type of mortgage you hear about most often. It's the bread and butter of the lending industry, but it has its own unique rules, its own secret advantages, and its own hidden traps. And it holds the key to the most sought-after prize in the mortgage world: figuring out how to get a loan without paying for mortgage insurance. And what most people don't know is that you don't always need 20% down to do it. So let's pull back the curtain on this thing called private mortgage insurance, or PMI. It's one of the most misunderstood and most despised costs in all of home buying. And for good reason. It feels like you're paying for an insurance policy that doesn't even protect you. And you know what? You are. PMI doesn't protect you, the borrower. It protects the lender. It's the lender's insurance policy against the risk that you might default on your loan. See, from a bank's perspective, a borrower putting down less than 20% is a higher risk. They have less skin in the game. If home prices drop and they owe more than the house is worth, they might be more tempted to just walk away. So, to offset that risk on a conventional loan, they require you to pay for this insurance policy. It's typically calculated as a percentage of your loan amount and added to your monthly mortgage payment. It could be $50, $100, even a few $100s every single month. That's thousands of dollars a year going towards something that gives you absolutely zero personal benefit. It just drains your wallet. This is why the 20% down payment has become this legendary, almost mythical goal for homebuyers. It's seen as the golden ticket to escape the PMI trap. But what if I told you that the 20% rule is more of a guideline than a hard and fast law? What if there were ways to structure your financing to legally and ethically sidestep PMI, even with as little as 10% down? This is where we separate the average homebuyer from the savvy one. The first and most classic method is something called a piggyback loan. You may have heard it called an October 10th 80. The numbers sound like a secret code, but the concept is brilliant in its simplicity. Instead of taking out one giant mortgage for 90% of the home's value, you take out two separate loans and combine them with your 10% down payment. Here's how it works. Let's imagine you're buying a $500,000 house. You have $50,000 saved up, which is 10% down. Instead of getting a single $450,000 loan and getting hit with PMI, you structure it like this: the 80 is your primary mortgage. You get a loan for 80% of the home's value, which is $400,000. Because this main loan is at that magic 80% loan-to-value ratio, it doesn't require PMI. Problem solved, right? But wait, you still need another $50,000 to actually buy the house. That's where the 10 comes in. This is the piggyback loan. It's a second, smaller mortgage for 10% of the home's value, or $50,000 in this case. This second loan sits on top of your primary mortgage. The final 10 is your own cash down payment of $50,000. So you have an 80% first mortgage, a 10% second mortgage, and your 10% down payment. Together, they add up to 100% of the purchase price, and crucially, you've completely avoided paying monthly PMI. Now, this isn't a free lunch. The interest rate on that second, smaller mortgage will almost always be higher than your primary mortgage rate because that second lender is in a riskier position. If you foreclose, the first mortgage lender gets paid back first. The second lender only gets paid if there's money left over. But here's the kicker. The interest on that second mortgage is often tax deductible, just like your primary mortgage interest. PMI is almost never tax deductible. So, in many cases, even with two separate loan payments, the total monthly cost of an October 10th 80 can be less than a single 90% loan with PMI attached. It's a bit more paperwork, a bit more complexity at closing, but it can save you thousands. But what if you don't like the idea of juggling two separate mortgage payments? There's another, more subtle way to avoid PMI, but it comes with a massive trade-off that you have to understand. It's called lender-paid mortgage insurance, or LPMI. The name sounds fantastic, right? The lender pays it for you. But as we all know, banks aren't in the business of giving away free money. With LPMI, the lender essentially pays your mortgage insurance premium for you in one lump sum up front. In exchange for this favor, they charge you a slightly higher interest rate on your loan. And here's the critical part. That higher interest rate is permanent. It lasts for the entire life of the loan, whether it's 15 or 30 years. Let's compare. With standard borrower-paid PMI, you pay that extra fee every month, but only until you reach about 20% equity in your home. Once you hit that threshold, you can petition the lender to remove the PMI, and your monthly payment drops. With lender-paid PMI, you never make a separate PMI payment, which feels great at first. But you are stuck with that higher interest rate forever, even long after you've paid down 20, 30, or even 50% of your loan. You're effectively financing your mortgage insurance over 30 years. So, who would ever choose LPMI? It's a strategic play for a very specific type of buyer. Someone who is absolutely certain they will not be in the home for the long haul. If you know you're going to sell or refinance within, say, 3 to 5 years, LPMI can actually save you money. The slightly higher interest rate over that short period might cost you less than paying the full monthly PMI premium. But if you plan on staying in that house for 10, 20, or 30 years, LPMI is a financial trap. It will almost certainly cost you far more in extra interest over the life of the loan than you ever would have paid in standard PMI. It's a short-term gain for long-term pain. So we have the piggyback loan and the LPMI trick. But there's a third, less common path. Finding a lender with a unique portfolio loan program. Some banks and credit unions, in an effort to attract high-quality borrowers, create their own in-house loan products that don't conform to the standard rules. You might find a program that waives PMI with only 10.1% down. Or you might find doctor loans designed for medical professionals with high earning potential but a lot of student debt, which often feature no PMI with very little money down. These are harder to find, and they require you to shop around beyond the big national lenders, but they absolutely exist. Now, for everyone else who does end up with a conventional loan and standard PMI, don't despair. You are not stuck with it forever. This is a temporary cost, and you need a plan to get rid of it as soon as possible. The Homeowners Protection Act gives you the right to request PMI cancellation once your loan-to-value ratio, or LTV, reaches 80%. This means you owe 80% of the home's original value. You can get there by two paths: paying down your mortgage principal, and your home's value appreciating over time. You have to be proactive here. Your lender isn't going to call you up one day and say, "Hey, would you like to stop giving us extra money every month?" No, you have to track your equity. Once you believe you've hit that 80% LTV mark, you need to contact your lender in writing and formally request that the PMI be removed. They will likely require you to be current on your payments and may require you to pay for a new appraisal to verify the home's current value. But that few $100s for an appraisal is a small price to pay to save thousands in the long run. And if you forget, the law does provide a safety net. Lenders are required to automatically terminate your PMI once your loan balance is scheduled to reach 78% of the original home value. But relying on this means you'll likely overpay for several months, or even years, compared to proactively requesting it at 80%. Understanding how to navigate the world of PMI is what separates a good deal from a great one. It's about more than just the interest rate, it's about the total cost of borrowing. We've just cracked the code on conventional loans, the most common type of mortgage in America. But they aren't for everyone. They typically demand good credit and a documented stable income. So what happens if your credit score has a few blemishes? Or if you can only scrape together a 3.5% down payment? Are you locked out of homeownership? Not at all. This is where the government steps in. And our next stop is the most popular government-backed loan program in the entire country, the FHA loan. It's the workhorse of the mortgage industry, designed to open the doors of homeownership to millions. But it comes with its own very different and far more stubborn version of mortgage insurance that you need to know about before you ever sign on the dotted line. We're talking about the FHA loan, the Federal Housing Administration loan. And that stubborn, sticky, almost inescapable mortgage insurance is called MIP, or mortgage insurance premium. It's the price of entry for what is arguably the most accessible home loan in America. Now, a huge misconception needs to be cleared up right away. The FHA doesn't actually lend you any money. They don't have a giant vault of cash they're handing out to homebuyers. Instead, the FHA acts like the ultimate co-signer. They insure your loan. They go to a private lender, a bank like Chase, Wells Fargo, or your local credit union, and they say, "Hey, we want you to give this person a mortgage, even though their credit score might be a little bruised, or they only have a tiny down payment. And if they stop paying, don't worry. We, the full faith and credit of the US government, will cover your losses." This government guarantee makes lenders feel warm and fuzzy. It takes almost all the risk off their plate, which allows them to approve borrowers they would normally turn away in a heartbeat. That's the magic of the FHA loan. It's an access product. It was created during the Great Depression to get the housing market moving again, and to this day, its main purpose is to help lower to moderate income families and first-time homebuyers get a foothold on the property ladder. You can potentially get an FHA loan with a credit score as low as 580 and a down payment of just 3.5%. Compare that to the 620, 640, or even higher scores and the 5 to 20% down payments often required for a conventional loan. It's a night and day difference. But this incredible access comes at a cost, a significant long-term cost. And it's called MIP. Unlike the PMI on a conventional loan, which is just a single monthly payment, FHA's MIP is a two-headed monster. First, there's the upfront mortgage insurance premium, or UFMIP. This is a one-time charge that, as of right now, is 1.75% of your total loan amount. Let's put that into perspective. Say you're buying a $400,000 house. Your loan amount after your 3.5% down payment is $386,000. Your upfront MIP would be 1.75% of that, which comes out to $6,755. Now, most people don't write a check for nearly $7,000 at closing. Instead, this cost is almost always rolled right back into your total loan amount. So now, you're not borrowing $386,000 anymore. You're borrowing $392,755. You're paying interest on your insurance premium for the next 30 years. It's a fee for the privilege of getting the loan, and you pay interest on that fee. It's the first bite of the apple. The second head of the monster is the annual MIP. Don't let the name fool you. It's paid monthly just like PMI. It's an ongoing premium that's added to your mortgage payment every single month. The exact percentage varies based on your loan term, your loan amount, and your down payment, but for most people getting a 30-year loan with minimum down, it hovers around 0.55% of the loan amount per year. So, on that same $392,755 loan, you take that amount, multiply it by 0.0055, and you get about $2,160 a year. Divide that by 12, and you're looking at an extra $180 added to your mortgage payment every single month. So far, this sounds a lot like conventional PMI, right? A little more expensive, maybe, with that upfront fee, but the same basic idea. Well, here is the critical difference. This is the part that trips up millions of homeowners. It's the reason I called it stubborn. With a conventional loan, your PMI automatically disappears once your loan-to-value ratio hits 78%. You build up equity, the insurance goes away. It's a temporary cost. With an FHA loan, it's a completely different story. And it all depends on your down payment. If you put down 10% or more on an FHA loan, your MIP will be canceled after 11 years. 11 years is a long time, but it's a finish line you can see. But let's be honest. The vast majority of people using an FHA loan are doing it precisely because they don't have 10% to put down. They're using the 3.5% minimum. And if you put down less than 10% on an FHA loan, that monthly MIP payment lasts for the entire life of the loan. Let me say that again because it is the single most important thing to understand about this mortgage. If you put 3.5% down, you will pay that extra $180 every month for 360 months. For 30 years. It never goes away. It doesn't matter if your home value doubles. It doesn't matter if you pay your loan down until you only owe $1. You will still be paying mortgage insurance. Over the life of that $400,000 loan, you will pay the upfront premium of nearly $7,000, plus the $180 a month for 30 years. That's another $64,800. In total, you're paying over $71,000 in insurance premiums. That's a staggering amount of money that builds you zero equity and has zero investment return. It's the pure cost of getting the loan. This is not a bug in the system. It's a feature. The FHA requires this life of loan premium to keep its insurance pool funded. Because they are insuring riskier loans, they know there will be more defaults than in the conventional market. These lifelong premiums from the borrowers who do succeed are what allow the program to exist and cover the losses from the borrowers who don't. So is the FHA loan a trap? Is it a bad deal? Not necessarily. It's a tool. And like any powerful tool, you have to know how and when to use it. The FHA loan isn't meant to be a 30-year financial solution. It's meant to be a stepping stone. It's the loan that gets you in the door when no other loan will. It gets you out of the rent race and into a home where you can start building equity and benefit from appreciation. The strategy, the exit ramp for homeowners with an FHA loan, is refinancing. The game plan is this. You use the FHA loan to buy your home. You spend the next few years making your payments on time, which helps build your credit score. Your property value hopefully increases. Once you've built up enough equity, ideally 20%, and your credit score is high enough to qualify for a conventional loan, you refinance. You trade in your FHA loan for a new conventional loan. And in that one move, you eliminate MIP from your life forever. You shed that extra monthly cost and move into a mortgage product designed for the long haul. So, the FHA loan is for the person whose desire to own a home right now outweighs the long-term cost of the insurance. It's for the person who has a solid plan to improve their financial situation over the next 2 to 5 years and has the discipline to execute a refinance when the time is right. It's a short-term bridge to the long-term goal of conventional homeownership. It opened the door for millions, but it asks for a heavy toll in return. It's a powerful, necessary, and deeply flawed product all at the same time. But what if you didn't have to worry about any of that? What if there was a loan program reserved for a very specific and very deserving group of Americans that completely throws the rulebook out the window? I'm talking about a loan that requires 0% down, not 3.5%. Zero. A loan that has no monthly mortgage insurance whatsoever. A loan with some of the most flexible credit requirements and lowest interest rates on the market. It's not a myth. It's very real, and it is, without a doubt, the single best mortgage product that exists in the United States. And it's what we're diving into next. It's called the VA loan, and it's not just a mortgage product. It's a promise. It's a certificate of gratitude, forged in the halls of Congress over 80 years ago, designed to do one thing: to say thank you to the men and women who have worn the uniform of the United States Armed Forces. This isn't some new trendy loan. Its roots go all the way back to 1944 to the original GI Bill. After millions of Americans returned from the battlefields of World War II, the nation faced a challenge: how to reintegrate these heroes into civilian life and give them a tangible stake in the country they fought to protect. The answer was a sweeping piece of legislation that provided education, unemployment benefits, and most critically, access to homeownership. The VA loan guarantee was born, and it single-handedly built the American middle class as we know it. It transformed the dream of a home with a white picket fence from a fantasy into an attainable reality for an entire generation. And that promise, that same powerful tool, is available right now in 2026 to eligible veterans, active duty service members, and certain surviving spouses. It is, without exaggeration, a financial superpower. So let's break down the 3 core pillars that make this loan unlike any other. First, and most famously, a 0% down payment. Let that sink in. 0. While your friends and colleagues are scraping together every penny for years, skipping vacations, and delaying life plans to save up the 3, 5, or even 20% required for other loans, a eligible borrower can purchase a home with absolutely nothing down. Think about the sheer power of that. The single biggest barrier to homeownership for most Americans, that massive 5 or 6-figure lump sum of cash, is completely eliminated. This isn't a special first-time buyer program with a million strings attached. This is the standard feature. It means you can go from renter to owner the moment you are financially ready, without having to burn through your life savings just to get the keys. The money you would have used for a down payment can stay in your emergency fund, be invested for retirement, or be used to furnish your new home. It's an immediate, life-altering advantage. The second pillar is just as powerful, but often misunderstood. No private mortgage insurance or PMI. As we've discussed with conventional loans, if you put down less than 20%, the lender forces you to pay for an insurance policy that protects them, not you. It's a penalty for not having a huge down payment. This can add hundreds of dollars to your monthly payment, money that builds you zero equity and provides you zero benefit. With a VA loan, there is no PMI. Ever. It doesn't matter if you put down $0 or $10,000. You will never pay a single cent in PMI. How is this possible? Because the VA in VA loan stands for the Department of Veterans Affairs, and they provide a financial guarantee to the lender. They are essentially co-signing your loan, telling the bank, "This person served our country. We have their back. If they default, we will cover a portion of your loss." This guarantee makes the loan far less risky for the lender, completely eliminating the need for PMI. Over the life of a 30-year loan, this single feature can save you $50,000, $60,000, even $70,000. It's a permanent reduction in your cost of homeownership. The third pillar is the foundation that holds it all up: incredibly competitive interest rates and more flexible credit requirements. Because the government guarantee reduces the lender's risk, they can offer VA borrowers some of the lowest interest rates on the market. On any given day, VA loan rates are typically lower than conventional loan rates. A quarter point or half point difference might not sound like much, but over 30 years, it translates into tens of thousands of dollars in saved interest payments. Furthermore, the VA itself doesn't set a minimum credit score. While individual lenders will have their own requirements, known as overlays, they are often far more lenient for VA borrowers than for conventional ones. The program is designed to look at the veteran's entire financial picture, not just a 3-digit number. It's built on the principle of giving a fair chance to those who have served. So, who gets to wield this incredible power? Eligibility is specific but broad. It includes active duty service members with at least 90 continuous days of service. It includes veterans who meet service length requirements, which vary depending on the era in which you served. It also includes members of the National Guard and Reserves who have 6 years of honorable service. And profoundly, it extends to the surviving spouses of service members who lost their lives in the line of duty or as a result of a service-related disability. The first step is always to obtain your Certificate of Eligibility, or COE, which is a formal document proving to the lender that you have the required service for a VA loan. You can get this through your lender online through the VA portal or by mail. It's your golden ticket. Now you might be thinking, this sounds too good to be true. What's the catch? There isn't a catch, but there is a cost, and it's called the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs to help keep the program running for future generations of service members, with no burden on taxpayers. The fee varies depending on your service, your down payment amount, and whether it's your first time using the benefit. For a first-time user with zero down, it's typically 2.15% of the loan amount. But here's the key. You don't have to pay this out of pocket. It can be rolled right into your total loan balance. And when you compare the one-time cost of the funding fee to the tens of thousands you'll save by never paying PMI, the math is overwhelmingly in your favor. Even more importantly, this fee is completely waived for veterans receiving VA disability compensation and for eligible surviving spouses. There are myths out there, old ideas that just won't go away. Some people think VA loans are slow and burdened by red tape. Decades ago, that might have been true. But today, with experienced lenders who specialize in VA loans, the process is just as streamlined and efficient as any other loan, sometimes even faster. Others believe that sellers are hesitant to accept offers from buyers using a VA loan, fearing a difficult appraisal process. This is also largely a myth from a bygone era. The VA appraisal has what are called minimum property requirements, but these are not about nitpicking paint colors. They are about ensuring the home is safe, sound, and sanitary for the veteran and their family. A good real estate agent who understands the modern VA loan process knows how to write a strong, competitive offer that any seller would be thrilled to accept. But perhaps the most incredible under-the-radar feature of the VA loan is this. It is a lifelong reusable benefit. This is not a one-and-done first-time buyer program. You can buy a home with your VA loan, live in it, sell it, and then have your full VA loan entitlement restored to buy another home. You can even, in some cases, have 2 VA loans at once. It is a benefit you have earned for the rest of your life. It is a tool you can use to build wealth and provide stability for your family, over and over again. It is a thank you that never expires. The VA loan is a powerhouse, a testament to a promise kept between a nation and its defenders. But what if you haven't served in the military? What if you still dream of buying a home with no money down, but your path is a civilian one? Is there a parallel program, a hidden gem that offers that same zero down payment power, but for a different kind of American dream? The answer is a surprising yes, and it's one of the best-kept secrets in real estate. It's called the USDA loan. And before you click away, thinking you have to be a farmer or own a tractor to qualify, let me stop you right there. That is the single biggest, most persistent myth about this program, and it's a myth that has cost countless families their dream home. The in USDA does stand for agriculture, but this loan is not about your occupation. It is about your location. This is the United States Department of Agriculture's Rural Development Guaranteed Housing Loan Program, and its mission is simple: to build up and populate the communities outside of major metropolitan hubs. To do that, they created a mortgage with 2 superpowers that are almost unheard of in the civilian world. First, and this is the one that changes everything, 100% financing. Let me say that again. 100%. That means zero down payment. Not 3.5% like an FHA loan. Not 3 or 5% like a conventional loan. Zero. On a $300,000 home, that's the difference between needing to show up with $10,000 and needing to show up with nothing but your signature. This feature alone catapults it into the same legendary status as the VA loan for those who qualify. It completely removes the single biggest barrier to homeownership for most Americans, saving up that massive pile of cash for the down payment. Second, because the loan is guaranteed by the government, lenders view it as a much lower risk. And what happens when risk goes down? Interest rates go down. USDA loans consistently offer some of the most competitive interest rates on the market, often lower than even a conventional loan for a borrower with excellent credit. So over the life of your 30-year mortgage, you're not just saving a fortune on the down payment, you're potentially saving tens of thousands more in interest. So what's the catch? There has to be a catch, right? Well, there are no catches, but there are 3 very specific gates you have to walk through to qualify. And they are all about ensuring this incredible benefit goes to the people it was designed for. Gate number 1 is the most important. Location. The property you buy must be in a USDA-eligible area. And here's where we bust that farmer myth once and for all. The USDA's definition of rural will absolutely shock you. We are not talking about a cabin in the middle of a cornfield, miles from civilization. The USDA has a map on their website, and you can type in any address in the country. You will be stunned to see that about 97% of the geographic United States is in an eligible area. This includes small towns, suburbs, and communities on the outskirts of major cities. Think of it this way: if you draw a circle around the downtown core of a big city like Atlanta or Dallas, the USDA ineligible area is usually just that inner circle. But the moment you get into the second or third ring of suburbs, the places with more space, bigger yards, and a quieter pace of life, you suddenly find yourself in USDA territory. For millions of Americans, the exact kind of community they want to live in anyway is already a USDA-eligible zone. This program isn't forcing you to move to the middle of nowhere. It's rewarding you for choosing a life just outside the hustle and bustle of the big city. Gate number 2 is income. This is not a program for the wealthy. It is specifically designed to help low to moderate income households. The USDA sets income limits for every county in the country, and your total household income cannot exceed that limit, which is typically set at 115% of the area's median income. This includes the income of everyone who will be living in the house, even if they aren't on the loan itself. So, if you're a high-earning couple making a combined $200,000 a year, this loan isn't for you. But if you're a teacher, a firefighter, a nurse, an office administrator, a factory worker, the backbone of the American workforce, you will very likely fall within these income limits. It's a sweet spot. You have to make enough to afford the monthly payment, but not so much that you're considered a high-income earner. Gate number 3 is the property itself. The home must be your primary residence. No vacation homes or investment properties. It also has to meet basic health and safety standards. The appraisal for a USDA loan is a bit more stringent. They want to make sure the foundation is solid, the roof isn't leaking, and the electrical and plumbing systems are functional. They are guaranteeing this loan. They want to make sure they're backing a safe, sound, and modest home. This isn't the loan you use to buy a sprawling mansion or a dilapidated fixer-upper that needs a gut renovation. It's for a standard, move-in-ready single-family home. Now, just like FHA and VA loans, because the government is providing a guarantee, they need a way to fund that insurance program. For USDA loans, this comes in the form of a guarantee fee. It's very similar to FHA's mortgage insurance premium. There are 2 parts. First, there's an upfront guarantee fee, which as of now is about 1% of the loan amount. But here's the key. Almost everyone chooses to roll this fee right into their mortgage, so you don't pay it out of pocket. Second, there's an annual fee which is much lower, currently around 0.35% of the loan balance. This is broken up and paid as a small extra amount with your monthly mortgage payment. People hear fee and they get nervous, but you have to do the math. Even with this guarantee fee, the combination of a zero down payment and a lower interest rate often makes the total monthly payment on a USDA loan less than it would be on an FHA or even a conventional loan with a small down payment. So who is this loan the perfect life-changing tool for? It's for the young couple who just got married, have good jobs and decent credit, but have been crushed by student loans and rent, and the idea of saving $20,000 or $30,000 for a down payment feels like trying to climb Mount Everest. It's for the family living in a cramped city apartment that realizes for the same monthly payment, they could own a house with a backyard for their kids just a 30-minute drive away. It's for the newly remote worker who is no longer tethered to a downtown office and wants to cash in on that freedom by moving to a community with a lower cost of living and a higher quality of life. The USDA loan is arguably the most powerful home buying tool that most people have never even heard of. It is the civilian's VA loan, a true zero-down path to the American dream, hidden in plain sight. It proves that you don't need a massive inheritance or a 6-figure salary to own a piece of this country. Sometimes, all you need is a willingness to look just beyond the city limits. We've now covered the big 3 government-backed loans. FHA for flexibility, VA for our veterans, and USDA for our heartland communities. They are the bedrock of the American mortgage system. But what if you don't fit neatly into any of these boxes? What if you're a successful entrepreneur, but your tax returns make you look like you're barely scraping by? What if the house you want to buy costs $1.5 million, far beyond the limits of a conventional loan? What if you have a unique financial situation that makes the rigid, automated underwriting systems of traditional mortgages just spit out denied? Are you simply locked out of homeownership? Not at all. There is a whole other universe of lending, a shadow market of specialized loans designed for exactly these situations. And in our final part, we are going to step outside the mainstream and explore the creative, powerful, and lesser-known mortgages that can make the impossible possible. And the key to making it possible is a category of loans many people have never even heard of. Non-qualified mortgages, or non-QM for short. This sounds like complicated financial jargon, but the idea is simple. A qualified mortgage, like your standard conventional loan, has to follow a strict set of government-backed rules about your debt, your income, and how it's documented. It's a rigid box. If you don't fit perfectly inside that box, the answer is often no. Non-QM loans are for everyone who lives outside that box. They are not subprime loans. The borrowers are often financially strong. They just don't have a traditional W-2 job and a 9-to-5 paycheck. These are the entrepreneurs, the freelancers, the real estate investors, the retirees with significant assets but low monthly income. Lenders who offer non-QM loans use common sense, alternative ways to verify that you can actually afford the home. They look at the real picture of your finances, not just what a tax form says. Let's start with the most popular one, the bank statement loan. This is the holy grail for the self-employed. Imagine you're a successful freelance consultant. You make great money, but at the end of the year, your accountant does their job and uses every legal deduction possible to lower your taxable income. You write off your home office, your car, your supplies, everything. On paper, your tax return might show you earned $50,000. But in reality, your business bank account had $300,000 in deposits over the last 12 months. A traditional lender looks at your $50,000 tax return and qualifies you for a tiny loan, if any. A non-QM lender offering a bank statement loan ignores the tax return. Instead, they'll ask for 12 or 24 months of your business bank statements. They'll look at your deposits, see the consistent cash flow, and use that to calculate your true income and qualify you for the home you can actually afford. It's a loan based on the reality of your business, not your tax strategy. For millions of American entrepreneurs, this isn't just a loan. It's the key that unlocks the door to homeownership that was previously bolted shut. Next up is a powerful tool for a completely different group of people. The asset-based loan, sometimes called an asset depletion or asset pledge loan. This is for the borrower who is asset-rich but income poor. Think about a retiree. They might only have Social Security and a small pension as their monthly income. A traditional mortgage lender would laugh them out of the office. But what if that same retiree is sitting on a $2 million 401k and a stock portfolio worth another $1 million? They are clearly not a lending risk. An asset-based loan allows the lender to convert that net worth into a qualifying income stream. They use a formula to deplete your assets over a period of time, say the 30 years of the mortgage, to create a hypothetical monthly income. So that $3 million in assets might be converted into an extra $8,000 a month in qualifying income. Suddenly, that retiree can easily qualify for a beautiful home to enjoy their golden years, without having to sell off their investments and trigger massive tax bills. It's a sophisticated strategy that lets you use the wealth you've built over a lifetime to live the life you want now. Now let's pivot to the investors. If you want to build a real estate empire, you will eventually hit a wall with traditional lenders. They'll only give you a certain number of mortgages, and they always qualify you based on your personal debt-to-income ratio. But what if there was a loan that didn't care about your personal income at all? Welcome to the DSCR loan. That stands for Debt Service Coverage Ratio, and it is the single most powerful tool for a modern real estate investor. With a DSCR loan, the lender isn't underwriting you. They are underwriting the property. The only thing they care about is whether the property's rental income can cover the mortgage payment and expenses. Here's how it works. Let's say the total monthly mortgage payment, including taxes and insurance, what we call PITI, is $2,000. The lender gets an appraisal that shows the fair market rent for that property is $2,500. You divide the rent by the PITI. 2,500 divided by 2,000 equals 1.25. That 1.25 is your debt service coverage ratio. Most DSCR lenders want to see a ratio of 1.2 or higher. Since you're at 1.25, you're approved. Notice what we didn't talk about? Your W-2, your tax returns, your personal job. None of it mattered. As long as the property itself cash flows, you can get the loan. This is how investors are able to buy 5, 10, 20 properties or more. Their personal income becomes irrelevant. Their success is based on their ability to find good deals. But what if your barrier isn't your income type, but your documentation status? For millions of hardworking people in the US who are not citizens and don't have a social security number, homeownership has felt like an impossible dream. But it's not. Enter the ITIN loan. An ITIN is an individual taxpayer identification number issued by the IRS to people who need to file taxes but aren't eligible for a social security number. And a growing number of specialized lenders offer mortgages specifically for ITIN holders. They'll verify income through other means, and they often require a larger down payment, but they provide a legitimate, structured path to owning a piece of the American dream. These are just a few of the big non-QM options, but there are even more creative tools out there. Ever watch one of those house flipping shows where they buy, renovate, and sell a house in just a few months? They're not getting 30-year fixed-rate mortgages. They're often using hard money loans. A hard money loan is a short-term, asset-based loan, usually from a private investor or fund. Speed is its main advantage. While a traditional mortgage can take 45 days to close, a hard money loan can close in a week. This allows an investor to snatch up a great deal before anyone else can. The trade-off? The interest rates are much higher and the loan term is short, maybe 1 to 3 years. It's a bridge. It's the financing you use to acquire and fix the property. Then, once the property is renovated and rented out, you refinance out of the expensive hard money loan and into a long-term, stable loan like a DSCR mortgage. It's a high-risk, high-reward tool for serious professionals. Finally, there's the most creative option of all, one that cuts out the bank entirely: seller financing. Also known as an owner carryback, this is exactly what it sounds like. The person selling you the house becomes your lender. You make your monthly payments directly to them. This can be a huge win-win. For the buyer, especially one who can't get a traditional loan, it's a way in. For the seller, it can mean a faster sale at their desired price. Plus, they get to collect interest income every month. The terms, the interest rate, the down payment, the length of the loan are all completely negotiable between you and the seller. It requires a lot of trust and a rock-solid legal contract drawn up by attorneys, but for the right situation, it can be the perfect custom-fit solution. And that's really the theme of this entire series. From the bedrock stability of the 30-year fixed we started with, all the way to these highly specialized creative tools, the goal has never been to find the best mortgage. The best mortgage doesn't exist. The only thing that exists is the best mortgage for you. For your life, for your finances, for your goals. The world of mortgages is a toolbox. A 30-year fixed is a hammer. It's essential and works for most jobs. An FHA loan is a power drill. It gets you through tougher spots. An ARM is an adjustable wrench, giving you flexibility when you need it. And these non-QM and creative loans? They are the specialized precision instruments that can solve the most unique and challenging problems. Our goal with this guide was to hand you that entire toolbox. To take you from someone who maybe only knew the word mortgage to someone who understands the strategy behind each and every option. You are now equipped with the vocabulary and the knowledge to walk into a lender's office not as a hopeful applicant, but as an educated partner in the transaction. You can ask the right questions. You can challenge the assumptions. You can advocate for the loan that truly serves your family's future. The journey to homeownership is one of the biggest financial steps you will ever take. But it doesn't have to be a confusing or intimidating one. It can be a journey of empowerment. The next step isn't to pick a loan from a video. It's to find a truly great mortgage professional, a broker or a loan officer who doesn't just know 1 or 2 products, but who understands this entire landscape. Use what you've learned here to find that person. If this series has made you feel even one bit more confident on that journey, then we have done our job. Thank you for spending this time with us. Now go build your future.